Ray Dalio is a billionaire investor and the founder of Bridgewater Associates, one of the world's largest hedge funds. He is known for his unique investment strategies and his focus on macroeconomic trends and principles. Dalio has written several books on investing and economics, including Principles, Life and Work in the Changing World Order, Why Nations Succeed and Fail.
The biggest issue is that there's more spending than we have income, and that's a problem. So then the question is, where are you going to get the money from?
Ray Dalio's statement highlights a crucial economic challenge that many individuals and societies face today. When spending exceeds income, it can lead to various financial problems, such as debt, inflation, and economic instability. It is essential to find a balance between income and expenditure to maintain sustainable economic growth and stability. Addressing this issue requires careful financial planning, smart investments, and responsible spending habits.
It's happened over and over again. We're now in the 12th and a half cycle. You know, these cycles, you know how the cycles work. You're 12 and a half cycles since 1945. 1945 was the New World Order, you know, new monetary system. And you know what happens. So let me take you through it quickly. You get a funky economy, weakness, and so on. So what we had, of course, in 2020 with the combination of COVID, and then also the move from the right to the left. There was a distribution of wealth. And so how did you do that? The government had to send out a bunch of checks.
Yep.
And the Federal Reserve, where did the government get the money from? The Federal Reserve lent it. So we have an imbalance. And of course, that put a lot of money in the system. You've got the demand, you've got the cycle, classic cycle, right? Stimulation, credit becomes debt, then you have inflation, then you have a tightness of monetary policy. And so where are we? So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trash. Now cash is relatively attractive.
Dalio is referring to the concept of long-term debt cycles, which he believes have been in operation since the end of World War II. According to Dalio, these debt cycles typically last around 75 to 100 years, and they are characterized by a series of economic and financial events that repeat themselves over time. One of the key features of these cycles is the buildup of debt and leverage in the economy, which eventually leads to a financial crisis and recession. This is followed by a period of deleveraging and consolidation as the economy works to reduce its debt burden and stabilize. Dalio's comments about the current cycle suggest that we are now in the latter stages of a long-term debt cycle, which began after World War II. He notes that the recent COVID-19 pandemic has accelerated some of the trends that were already underway, such as the redistribution of wealth and the expansion of government intervention in the economy.
Classic movement, of course, as rates go up and money becomes tight, you lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right? So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash, all of that comes down.
The factors that can contribute to the bursting of economic bubbles, such as excessive debt, rising interest rates, and a decrease in credit availability. These factors can lead to a decline in asset prices and a contraction in economic activity, which can trigger a downward spiral of defaults and bankruptcies. When the economy experiences stagnant growth or recession, high unemployment, and high inflation, it is a challenging economic scenario because policymakers often have to choose between fighting inflation or stimulating growth. Ray Dalio's comment suggests that he sees a potential for a stagflation-type environment where growth is slow and inflation remains high or even increases.
An environment with something close to maybe a 1% growth rate, something like that, right? Happening in that cycle since 1945 is that we then have the accumulation of a lot of debt and money. Okay, so we deal with things like the debt ceiling. Does the debt ceiling matter? Does it matter how much debt we have? And then you have a situation where there's used to be a free market supply demand, but now you've got the Federal Reserve who is now taking it, buying it on the balance sheet, so it's not the supply demand. So you've got that dynamic very, very classically going. I don't think people are paying enough attention to the big cycle. There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt.
The importance of understanding the long-term debt cycle and its impact on the economy. Since 1945, there has been an accumulation of debt and money, and that the actions of the Federal Reserve have disrupted the traditional free market supply and demand dynamics. By paying attention to the big cycle rather than short-term cycles, investors and policymakers can gain a better understanding of the broader economic trends and make more informed decisions about managing debt and monetary policy.
This type of recession is not a bad recession. It's a lot less bad than I thought it would be, because of the fact of how it's distributing and shrinking that credit. At the same time, though, we have a real issue for the United States debt in the world, because we're selling all this debt. You know, if you look at wealth instead of GDP, wealth is a much better indicator of things. GDP is like looking at revenue. How much did you sell? We have borrowed a lot of money, okay? And now we're having a problem selling that money around the world.
Right.
And it's also happening that this political situation, geopolitical situation, is weakening the demand for U.S. bonds. I think the biggest issue is that there's more spending, and I would say there probably needs to be more spending than we have income. And that's a problem, right? Governments run the same as your household or a business, in that, with two exceptions. They can print money and they can tax, right? So then when you spend more than you earn, the question is, and they're going to spend more than they're going to earn, where are you going to get the money from? Are you going to get it from taxes? And if you get it from taxes, people fight because they don't want to give up their money. Or are you going to get it from printing the money? And so how do you achieve that balance? Because do you spend less?
Right.
Well, it's a tough environment to spend less. You have to spend more on defense. You have to spend more on rebuilding. The Green Initiative is expensive. I mean, education is expensive and so on. So there's a dilemma that she is sitting in, that we as a country are sitting in. So, you know, how do you solve that problem? I think that, you know, if you were to, let's say, take the bigger picture, there's a lot of things that you can invest in that will produce returns. And I think, for example, I don't think we invest nearly as much in the basic things like great education and making sure that certain areas do not have conditions that are substandard conditions. And so to invest in those things that are going to produce productivity. Education's a good thing. Infrastructure's a good thing. Other things. But this is part of a cycle, a big cycle that has happened over and over and over again.
Market is. Do you think that we have priced in what could be a recession, or what is a recession? Did we see the worst of it in October? Where are we right now in terms of valuation?
I think the markets as a whole they were obviously, I would say, the interest rate changes were obviously had to come. The impact on the other markets had to come. They have come. They have been into the price. So now you're going to have probably a tightening or a tighter monetary policy than existed. And that's a net negative for the stock market, but not in such a big number that it's like a big bearish thing. So when I look at the market as a whole, I would say, okay, well, now it seems closer to fairly priced, probably still a bit high, given that whole picture.
In conclusion, Ray Dalio's comments highlight some of the significant economic challenges that we face today, including the accumulation of debt and the potential for a stagflation-type environment. It is crucial for individuals, investors, and policymakers to pay attention to the long-term debt cycle and its impact on the economy to make informed decisions about financial planning, investments, and monetary policy. By taking a big-picture approach and understanding the broader economic trends, we can work towards achieving sustainable economic growth and stability. Thank you for watching, and I hope this discussion has been informative and helpful.